My name is Liam Crummy. I'll be attending the University of Wisconsin.
My name is Chase Jacobs. I'll be attending University of Notre Dame.
My name is Francis Knoll. I will be attending the University of Virginia.
My name is Thomas Lawton. I'm going to University of Notre Dame.
My name is Arturo Martinez, and I will be attending Duke University.
My name is Lorenzo Miller, and I'll be attending the University of Michigan.
I'm Gabe Nissen, and I'll be attending Georgetown University.
My name's Sam Rossi. I'll be going to Trinity University.
So first, we will be beginning with fiscal policy recommendations given the current economic conditions. Now, one of the biggest problems we face currently is that national debt has increased to an unstable amount, and our economy is under inflationary pressures. Now, our current debt is 34 trillion, with our current GDP being only 28 trillion. And the real issue here is that we spend 6.6 trillion with a 1.8 trillion spending deficit. Now, as seen in the graphs, our spending is only increasing as well as the interest we pay on our debts. So the best solution to this is to cut government spending and also to repurpose government spending. Now, in terms of repurposing government spending, we should be decreasing international aid and focus on domestic infrastructure. We have spent 175 billion on Ukraine over the past 2 years and 26 billion on Israel. This could be spent on the following: targeted stimulus for affected individuals and industries by the pandemic and natural disasters, infrastructure investment for short-term job creation and long-term productivity to add to the aggregate demand curve, support for small businesses through grants, loans, and tax incentives, investment in education and training for a skilled workforce to increase human capital. Furthermore, our debt can be managed through revenue generation measures like closing tax loopholes and raising corporate tax.
Shifting towards monetary policy. In order to make recommendations for the Fed, we first have to examine the current macro indicators that they look at. So starting with the CPI, in April, the CPI came out to be 3.4%, which is a slight uptick from the previous month. And that uptick represents a scary short-run inflationary trend. Secondly, the core PCE, which excludes food and energy due to its lagging effect in tracking inflation, also showed a short-run increase as it moved up to 3.7%. Unfortunately, as inflation slightly increased, the economy showed some signs of weakening, as April only recorded 175,000 new jobs, which is another tick downward from previous months this year. These trends show that this idea of a soft landing might become more and more less likely, which is where inflation falls to 2% without any repercussions. Obviously, just because there needs to be more work to be done to get inflation down to 2%. Therefore, investors will have to accept the fact that the free money era after the great financial crisis is over. And therefore, we believe that the federal funds rate should remain at 5.33% to avoid any recurring inflation that could happen.
So, due to the Russian-Ukrainian conflict, the United States banned all imports of fossil fuels from Russia in March 2022. So, in the primary graph, you can see a benchmark statistic of oil prices across the United States. Throughout 2022, oil prices increased by almost 100%, leading to a massive negative supply shock, increasing price level, and thus leading to the necessary contractionary monetary policy from the Fed. In the bottom graph, you can see the statistics of open market selling from the Fed to decrease money supply as an attempt at contractionary monetary policy. And as you can see, throughout 2022, there was about a 50% increase in Fed bond selling. In the next slide, you can see the effects of the negative supply shock throughout the United States, looking at the PPI of general manufacturing of goods and services. There's a massive spike in Q1 of 2022 following the increase in input prices for oil for productions of goods and services, especially affecting, as I said, manufacturing and small businesses.
Now, looking at a few key indicators of the current state of the economy, namely the NASDAQ, Dow Jones, and S&P 500, which are up an impressive 9.75, 5.19, and 11.9% year to date. These positive figures suggest a relatively healthy economy, However, there are more important factors to consider that may indicate this outlook isn't entirely accurate. First, it's important to note that all three of these indexes are heavily influenced by the information technology sector, Microsoft, NVIDIA, Alphabet, Apple, Meta, which is currently thriving and well outperforming the market, primarily due to the increasing value of semiconductors and the outward look of how these help build artificial intelligence technology. Interestingly enough, Apple, which had the highest market capitalization of all these companies until recently, is the only one that hasn't outperformed the market, but that is expected to change as they catch up with the AI race. Looking ahead, if these indexes continue to show signs of market health while the inflation remains higher than desired for investors and for the government, we may not see the anticipated rate cuts that the Fed promised at the start of this year. And as a result, these current all-time high watermarks, such as the S&P's impressive 5,300 points, might not hold and could potentially fall back by the end of the year or remain at this watermark. Overall, while the year-to-date gains in the indexes reflect a strong market, the underlying factors, especially the dominance of the tech sector, suggest a more complex reality, and we must consider this when we recommend our policies.
So now we're going to be talking about the job markets and how the overall employment situation has impacted the economy. So if we look at our labor shortage that's been happening after COVID, our labor force has still not recovered from the previous numbers. In February 2020, we were at 1.7 million more Americans that were participating in the labor force. And we have 8.5 million job openings, but only 6.5 million unemployed people to fill them. And we already know that labor force participation rate has been shrinking consistently for the last 2 decades. But this massive increase was only really as big during COVID. If you can see in the graph, there's a little sliver that's gray, and then that massive fall off is 2020 when COVID started. So if we look at the reasons for why that happens, 2/3 of Americans who lost their job during COVID say that they're only somewhat or not at all looking for a job. Half are not willing to take jobs that don't offer remote work. 20% alter their livelihood. 17% have retired. 19% have transitioned to homemaker. 14% are now only working part-time. And about a quarter say that government aid packages during the pandemic incentivize them to not look for work actively. Since the supply of labor has decreased, next slide, please. Since the supply of labor has decreased from the pre-pandemic rates, there's been a hike in wages. So obviously, since supply decreases, the wages must go up to fill that gap. And so the cost of labor has increased overall. And since labor has gotten more expensive and labor productivity has decreased overall because there's less people working, the added expenses of employment have caused firms to have to spend more, which has increased inflation. So the Fed recently said that unemployment and inflation are moving towards a better balance in the future, but it's still uncertain. And so thus they're being attentive towards those risks of those two indicators. So moving forward, we should pay attention to the current job slowdown, like Chase already mentioned, how April was the slowest month for job creation in 2024. And we should look at the overall labor force participation rate for the next couple of years, because again, it's on a downward trend, but it's still recovering from COVID. So we have to look at how it changes. And thus, when we look at the labor shortage ending, we can make better recommendations for our economic policies in the future.
Oil prices hit a 5-month high in April, but are slowly decreasing. This increase is largely due to the political tension in the Middle East. Demand has also seen an increase because ships and planes must take longer routes to avoid the Middle East. This is seen in the closure of the Suez Canal and Israel being classified as a level 2 flyover risk, only 1 level below a no-fly zone. Higher demand will help sustain consumption growth in the economy, which will be beneficial to the financial markets. With the summer road trip season ahead, demand is expected to increase even more and raise prices for oil. If policymakers want to keep oil prices in check, I recommend that policymakers consider increasing subsidies and other incentives for EV use, as it is a substitute for gas vehicles.
And some indicators that analysts should closely monitor are bond yields and federal spending. The Ukrainian-Russian conflict has caused an inflationary pressures in areas such as energy and agriculture, leading to higher global energy prices and commodities. At the beginning of the conflict, many investors sought safe haven assets such as treasury bonds, causing a temporary drop in yield from 2.05% mid-February to around 1.72% in early March, shown in the red lines and the arrows. Driven by the ongoing inflation concerns of Federal Reserve rate hikers, yields has increased by 3.5% in 2022. With the United States involvement in Ukrainian-Russian conflicts, the U.S. has committed itself to supporting Ukraine financially while also increasing its own defense budget. This has considerably increased government spending, and consequently, the Federal Reserve has entered the higher deficit levels beginning 2022, shown by the graph on the right, showing a sloping deficit, showing increase in the deficit spending. This trend has continued into 2024 and has shown no sign of stopping. The larger the deficit, the higher the federal government interest expenses, with net interest currently standing around 658 billion, crowding out spending on potentially more productive investments for the economy.
When looking at certain events or unanticipated events that analysts should pay attention to for the impact on the economy and financial markets, it's hard not to pay attention to the election coming up in November. According to Forbes, at the moment, Trump leads Biden in 5 of 7 swing states: Arizona, Georgia, North Carolina, Pennsylvania, and Wisconsin. And they are tied currently in Nevada, and they believe Biden has a 1-point lead in Michigan. However, many other sources like the New York Times believe Biden and Trump are tied, while other credible sources believe Biden is winning. So the presidency is really not assured at this moment, and economists cannot really assume who will be sitting in the Oval Office next year and will be ultimately influencing governmental policy. But this is only 1/3 of the worries when thinking about the election, because the House is also up in the air. As you can see on the right, although Republicans have more solid seats, Democrats make up for it in the likelies and leans, and you could see that in the toss-up area, once again, it's pretty hard to tell who will be taking majority in the House. So, again, economic policy and governmental policy will not really be in like a certain place for where they see it in the future. And then again, likewise, the Senate will not be certain to who will be holding the majority. At the moment, 30 seats are up for re-election, 20 of which are Democratic and 10 of which are Republican. At the moment, Democrats do hold the majority in the Senate with 51 seats, with 3 of them being independent, but leaning a little more left. So the uncertainty of what the governmental makeup is going to look like after November incentivizes businesses and corporations to not really make great economic changes and plans, because they wish to wait out the summer until they can see what governmental policy takes control and takes the reins, so they can better strategize how they want to run their business. Thank you for your attention.